The price of nickel exploded by over $50,000 in one day, doubling to reach over $100,000 per metric ton before the exchanges just said, we're shutting down, we're closing, we're halting trading, and we'll let you know when we're coming back online. Not only has this prompted a lot of uncertainty with the traders who still have open positions or who not are even certain whether their closing orders were filled or are going to be honored. Also, we've seen massive losses with both giant institutional funds, up to $8 billion in losses for one Chinese nickel trading firm. And then we also saw massive losses for retail traders through the shutting down of triple leveraged short ETFs trading on nickel. Crazy times. Ready? Let's dive in. All right, so the price of nickel obviously has been on the rise recently, and then on Tuesday just exploded higher, and then it had to be halted from trading. The London Metal Exchange could not keep up with orders, was seeing some massive uncertainty and chaos in the markets. They halted trading, and they said they're probably going to be closed for about 4 days. One of the issues is dealing with the handling of orders that came in that they haven't filled yet, orders that they said they filled and are now canceling, orders that they haven't yet canceled that they might cancel. It is all a mess right now. This rise in the price of nickel, as with everything going on right now, has been prompted due to the sanctions on Russia, as Russia is a big supplier of the world's nickel. And no, we can't just gather up all of our nickels, our 5-cent coins, melt them down and get nickel that way, because shocker, there's no nickel in them. They're called nickel because they used to be made out of nickel, because nickel is a valuable metal, but no longer because no US money has any real value. But nickel is a very important metal worldwide. Obviously, it's used in electric vehicle batteries, and so we might see some more supply chain issues there, maybe some prices going up in electric vehicles due to the battery costs, but it's also a key ingredient in being able to make stainless steel. So if this doesn't work its way out fairly quickly here, we might be in for much higher prices of steel and maybe some stainless steel shortages. This rise in nickel over the last couple of weeks, but especially today, has led to commodity funds, broad-based commodity funds, have participated in some of that price rise like DBC. However, not all ETFs that are tracking commodities, especially nickel, have done well, especially because you have to be careful. Some of these funds are short funds, meaning that they go up when the commodity they're tracking goes down, or they go down when the commodity they're tracking goes up. And what has gone up a lot recently? Nickel. And because of that, this Wisdom Tree ETF that is a 3 times leveraged ETF, but it's a short ETF, meaning it goes down by triple the amount that nickel goes up each day. Do you think that's had any good performance recently? No. Over months, it's been absolutely slaughtered, and just today they announced they've had to close down the fund because at the end of the day, the fund was worth less than zero. Now, normally, if an ETF closes down because of massive losses, there's a small amount of cash left over that's distributed to the investors. In this case, there is absolutely zero. Now, thankfully, the total assets in this fund prior to today looks like it was only about $7 million, so hopefully nobody had too much money in this. But unfortunately, in extreme moves like this, there are going to be big losers, and it looks like one of the biggest losers here was a large nickel company in China who is facing an $8 billion trading loss as a result of the price rise in nickel. Now, obviously, this has led some banks in China who have loans outstanding with this company to be slightly concerned at these massive losses. However, on Tuesday, this firm assured the banks that its financial position was sound and that it could weather even extreme losses from the forward contracts, which means that while they might be facing $8 billion in losses on this trading, it's also possible that that is offset by their actual business, that this won't produce any extreme losses for the company overall, a net loss, that this is just something that they have been doing to hedge, and so the price rise causes their hedges to have a massive loss, but they also have that offset by their fundamental business. However, it does depend on how much of their metal they already have locked in at a sale sale price and what price that sale is locked in at. Now, with these crazy moves going on, the question is, number one, why did it happen? And number two, what can I make sure that I do to not get trapped by something like this? Well, number one, why did it happen? This was essentially a short squeeze. When you have supply dry up like that on something that already has bullish momentum, anybody who is short the commodity must cover. And big companies that have large hedged positions, that position itself is a short position. And so with crazy market behaviors, even a hedger might be forced to cover and close out those shorts. The problem is, when you short something, that means you are selling it, and then in order to close out that trade, you have to buy it. But in order to buy it, you've got to have somebody else willing to sell it to you. And in crazy market movements like this, if the only thing everybody is trying to do is close out their shorts, everybody's trying to buy, and nobody can open up a new short, maybe everybody who already had the ability to sell and close out their long positions has closed, there may not be anybody left in the market to initiate a sell order to sell to everybody who needs to buy in order to close their shorts. It's a classic short squeeze. Pretty much everybody is familiar with something like this happening over the last couple of years, especially with the meme stocks. We saw it happen in GameStop and AMC. We saw it briefly happen in silver, although it didn't pan out to anything. But when you have large short positions in any type of asset, you do have the fundamentals there. You have it baked in the cake. You have the possibility for a short squeeze to happen, where everybody is trying to buy because they have to, and nobody is left to sell. Which brings us to how to protect yourself from getting stuck in something like this. Well, number one, do not ever expose yourself to unlimited loss, even if the possibility, the potential for that unlimited loss is theoretical. You've done the math, you've done the calculations, you've back tested it, you've looked at history and you said it cannot happen because it has never happened. The likelihood that it would happen is zero. Doesn't matter. That's a sucker's bet. If the loss potential on that trade is even theoretically unlimited, don't take that trade. I had to learn this lesson the hard way a couple of times when I first got started trading, and it was the best thing to ever happen to me because while I lost a lot of money in terms of my net worth percentage early on, that taught me, hey, those are fool's bets. Don't make those trades. Instead, take the opposite trades where you might have a much smaller chance of winning, but if you win, you have an unlimited win potential. Theoretically, you have a limited loss potential. No matter what, you can't get wiped out. You're not relying on probabilities that are inherently unknowable. And finally, if you're not already, I would love to see you on Locals, where I post exclusive content available just for supporters only. My link is in the description below. As always, really appreciate you guys. Thanks so much for watching. Have a great day.